From New York City for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, a mixed jobs report sends yields sharply lower, delivering some relief after a brutal stretch for long-dated bonds following a shock U.S. downgrade and boosted Treasury auctions. We begin with the big issue, making sense of a wild week.
It's the job report that has something for everybody.
You've got a solid economy.
The U.S. economy continues to power through.
We do query whether the payrolls numbers are telling the real story.
It's an economy that's in good shape, but that is moderating.
There's still risks out there.
The bond market.
The U.S. Treasury market isn't like other bond markets.
We're experiencing a wrecking ball.
This was the year of the bond, right?
That 5 to 10 year part of the curve is the most sensitive part.
Are people really going to be willing to accept a 4% 10-year note?
You've had a very rich 5 to 10 year part of the curve.
It seems so high to us because it's been so low.
You wonder, what is the long end doing for you?
It's hard to convince people to go towards the long end.
Long interest rate exposure is becoming questionable as value.
Joining us now, I'm thrilled to say we have RBC's Blake, Gwinn, and Earl Davis of BMO, both from Canadian banks, which is a little bit fun. And Blake, since you're on set, I'll start with you. And it's hard to know where to start on a week like this one. So let's go right to the price action, because if you look at 10-year yields, they were up, 23 basis points from Monday through Thursday, only to fall 11 basis points or so today. How do you make sense of that kind of volatility in benchmark Treasury debt?
With these big moves, I always like to separate things out into two kind of pieces. A lot of times you have the fundamental piece, which is good for the first, 1/3 to 2/3 of the move. And then after that, things become a little bit frothy. And I think we crossed that line at some point earlier this week. I think there's some very good reasons that yields have moved higher. But I also think that at some point you cross some technical levels, volatility starts to feed on itself. And that really pushes higher. And so it's not really surprising to me that we're giving some of that back today. But I still expect we're going to come out of this with steeper curves, higher yields overall.
And could you quantify that? When we talk about higher yields, if I think about for 10-year yields, for example, we got up to above 430 back last fall. Are we going to revisit those highs?
It's certainly possible. I think what's really going to be key over the next week is just seeing if we drop back below that 4% level, if this becomes kind of a new floor, or if we drop back into that range that I think we were pretty comfortable with, back in July, with 4% being kind of a ceiling. So I think seeing what happens this week and where we fall is going to be very telling. But I will say, and this whole thing kind of started on a supply story, I think. I think that was one of the major catalysts. And I think if you look back over the last year, yields were really driven entirely by what the Fed was going to do over the next meeting or two. That was responsible for most of the volatility and rates, the curve. And I think we are moving into, on the eve of kind of transitioning into a bit of a different environment where with the Fed on hold, with them not likely to cut until mid-2024, some of these other things that have been on the back burner are going to start to become more important. Supply is one of those. We've had very low supply for a long time. Monday, when this thing really started to kick off, we got information from Treasury that kind of shocked markets and told them there was going to be a lot more supply. That's coming against the backdrop of weaker demand from banks, from overseas. So I think this idea that term premium and some of these other things that tend to drive bond yields coming back and taking some of that volatility away from just being entirely about the Fed path. I think that's what we're entering into, and that's why I think it is possible that we hold on to these higher yields for a while. Well,
Earl, let's talk more about supply, because of course we got the refunding announcement this week, and it was bigger than expected. $103 billion of longer-term securities sold next week. The expectations, I believe, for $102 billion. How much does supply actually matter in the world's biggest bond market?
Supply is 1/3 of the equation. The other side that matters is who's going to buy the supply. And over the past 2 years, we've taken out two of the largest buyers of the supply. One of that's the federal government through QE. We no longer have that. And then you take out largely the second largest buyer, which is Japan, because now they could buy domestically. So what happens in that environment is rates have to find a new level to clear. They have to reprice to the next marginal buyer. And we do believe that is at higher yields than we saw at the highs of last year.
And you do have, some big names coming out saying that they're outright shorting the long end of the curve. I'm talking about Bill Ackman specifically here, the Pershing Square chief, saying on Twitter, or X if we want to call it that he's short in size the 30-year Treasury, and he had a myriad of reasons. But Earl, when you say that yields probably have to reset higher from here, is there enough conviction there to actually short this market?
Well, yeah, there's actually one important tailwind that adds to shorting the market. Because of the inverted yield curve, when you're short the market, you actually make money every week and the market doesn't move because of the negative carry, which is positive if you're short. So I think that's a significant tailwind that allows individuals of size, institutions of size, to feel comfortable being short at these levels.
And where do you go on the other side of that? Because, for example, we've also heard from the likes of Elon Musk actually replying to Ackman on Twitter, or X, I keep calling it Twitter, saying that T-bills are a no-brainer here. Well, if you do short the long end, does that marry with maybe staying in cash here?
You know what makes total sense to me? Cash has become a new asset class, basically. Before we looked at cash as where to park your cash. Now you can look at cash as where to invest your cash. And you know what? T-bills make a lot of sense at this point in time because you have the ability to go longer when you want to, or to go into risk assets when you want to. It provides you a lot of flexibility at a 5% rate. So I agree with that.
And Blake, it's interesting. I feel like before this week or last week, the conversation around cash had really been about opportunity costs, that you don't want to stay out in cash too long. Now it feels like the conversation has changed again, and people are saying that cash is pretty much just in a sweet spot. Where are you currently on cash?
Look, the yields are still very attractive. And I think if you look at how markets have taken down, this big slug of bill supply, I think last time I was here, we talked about the coming wave of bill supply. Markets have done very well with that. So clearly people are still interested in buying that cash. Still a lot of money to be put to work. We haven't seen those cheapen as much as I think some people had been expecting. I think there's still a lot of appetite for that cash. We have a lot of bill supply coming too, by the way. When we got that surprise on Monday, it wasn't just about coupons. We also, it implies a very big increase in bills as well. So a lot more vehicles there coming online. Now maybe we see that cheapen. But I think markets are going to continue to take that down. I mean, if you look at where the overnight repo facility at the Fed is, it's come down, but it's kind of started to basically go sideways at around 1.7 trillion. That's still a lot of dry powder that's sitting at that facility that could come out and buy these short-term cash-like instruments. So I still think that stuff stays pretty well bid.
And where is the demand coming from? Because it was interesting hearing Earl saying that, we've removed two of the biggest buyers for outright Treasury bonds, one of them being Japanese buyers. Where is the demand for bills coming from?
Well, I think to a big extent, it's people like myself who are earning 10 basis points on a bank deposit not too long ago and see these kind of yields that are available at the very front end. Maybe it's not the bulk of kind of your investment strategy, but as far as getting that additional return and seeing the kind of numbers we see on these money fund returns at this time compared to where they've been for the last few years, I'm not surprised that people are continuing to move out of lower yielding instruments into those. We're not talking about people coming out of high yield securities or bonds into bills. It's really coming out of bank deposits and other places like that.
And, the conversation we're having so far, we really haven't talked about the Fed that much, which is amazing to me, Earl. And like you said, we really are focused on supply here. But when we focus on the fundamentals of this economy and what the Fed will do, obviously we have a big data point next week in the inflation report. And if you take a look at the expectations, actually, it's for a little bit of a reacceleration, at least on the year over year number. A lot of that, of course, comes down to base effects. But what does that potentially mean for the Federal Reserve? And is that reacceleration a dynamic that you expect to continue?
Yeah, you know what? I start with the base case. The Fed, the central bankers don't want to hike rates. I think that's pretty obvious. But I think they will hike rates, and they'll be forced into that through the data. And the data has shown extreme resiliency, not just the economic data, but look at the earnings results, right, that are coming out. There's no earnings recessions. Margins are robust, and they're able to maintain that. So that tells me, even though we are restrictive, we're not restricted enough. And that's the key thing that the Fed's looking at. So I do think the base case, they want to wait to see to hike. I think they will wait. There's maybe a couple more this year, only because they don't want to. But that's why you get us making new high rates on 10s and 30 years. Because as I said before, demand's 1/3, supply's 1/3. The 1/3 I did not talk about is risk premium, inflation risk premium. And if the Fed doesn't hike enough, then that just goes into the longer term as a risk premium. So, and that's what we're anticipating this year.
And Earl, to your point that the Fed doesn't want to hike anymore, we actually heard from Atlanta Fed President Raphael Bostic earlier saying that he sees no need to hike anymore, that the labor market is slowing, and maybe they don't want to hike anymore. But what about the balance sheet? What about quantitative tightening? What do you think sort of the urgency at the Fed is when it comes to the balance sheet?
Well, as they said, quantitative tightening is unknown, right? It's the first time we're going through this. So yes, you could theoretically think it impacts the economy, but they don't know. And at this point in time, especially because of financial stability concerns in the background, as we saw in March and whatnot, they don't want to add another unknown to the equation. So I think they continue as is, no matter what happens, tell you the truth, because they don't want to add that unknown or increase the possible financial instability in the background.
And Blake, we don't have a ton of time left, but I am curious to hear your thoughts, not necessarily on how many more hikes we're going to get, if any, but the question about cuts. When do you expect to see the first rate cut from this Federal Reserve?
So we've pushed those out into second quarter of next year. So we think they'll be on hold for a while. And I should say the path of those cuts, we don't see a sharp pace of cuts. This is a gradual adjustment process back to something closer to neutral, not a very urgent need to get back below accommodative levels.
And is that due to a recession, or is that just to get back to neutral?
No, this is more falling inflation, making the real yield passively getting tighter and tighter. So they're going to need to kind of counteract that as inflation falls. The real side of the yield, that's the name of the show, that's going to continue to go higher. So I think at some point they have to start pulling those rates back so that the real yield doesn't get tighter and tighter.
Well, on that real yield note, it's a good place to end it. Blake Gwinn and Earl Davis, thank you both so much. Really enjoyed this conversation. Up next on Real Yield, it's the auction block. Wells Fargo returns again for another sale. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block, where Europe was a bit quieter than here in the U.S. Today, we had another day of zero sales in the region, and the whole week in total saw just one deal. We've now seen 23 zero days this year. Over here in the U.S., it was a different story. Weekly volume topped $34 billion, led by another sale from Wells Fargo, the bank with 3 sales in recent weeks. And in high yield, supply hitting $100 billion for the year, jumping by over 40% year over year. Still, it's the slowest for new issuance since 2009. Meanwhile, Citi's Richard Zogheb says that Fitch's U.S. downgrade presents potential benefits for AAA company debt.
I do think those companies benefit because I think if you look back, a few years ago when we had the European sovereign crisis, what you saw there is a number of investors replaced sovereigns in their portfolio with multinational safe corporates. And I think you could see a little bit of that happen here as well. Unfortunately, the group of companies is small enough that you can't, there's only so much you can do.
Joining us now, we have BlackRock's Amanda Lynam and John Sheehan of Osterweis Capital Management. And Amanda, I'll start with you because most of the conversation around the U.S. downgrade has been related to the Treasury market. But when you think about the corporate credit markets, what potential ripple effects could there be from that downgrade?
Hi, Katie. Thanks for having me. I think really what we're seeing is this kind of combination of news flow over the past 2 weeks, whether it was the Japanese tweak to yield curve control or the downgrade or the Treasury supply or the better economic data, really kind of reinforcing this higher cost of capital environment that we're expecting to be front and center for the corporate credit market, specifically the speculative grade issuers that are more sensitive to those borrowing costs. And as we've seen long end rates move higher, year, it's really reinforced that view. I think the other really interesting thing that wasn't talked about as much this week was the recent data on bank lending and the pretty significant contraction there. And I think one of the things that we've been emphasizing is, one, the read-through to economic activity might not be as direct in this cycle relative to past cycles. So it's been well telegraphed that bank lending conditions haven't been this tight except for previous recessionary episodes. But the big difference between now and those periods has been the significant growth of the private debt market and firms' ability to diversify their funding sources. And so we think as that contraction in bank lending continues, which the survey made clear that it will, we think that that opens up an opportunity for private debt to expand its addressable market and increase its pricing power. But kind of bringing it back to the corporates, I really think that there's not really relief in sight from a cost of capital perspective. So then you have to pivot to, well, what's the second order implication? It's dispersion and it's an uptick in defaults, which we expect. And I would say that's true even without a recession.
And it's a good reminder, we did get the Fed Senior Loan Officer Opinion Survey on Monday. And John, that feels like actually a decade ago. I kind of forgot about that. And I mean, Amanda laid it out well, that it did show a continued tightening, that credit is becoming less available. When you think about the investment grade market from just a sector standpoint, where does that leave you on financials, for example?
Yeah, we think the investment grade corporate market is showing signs of late cycle. Valuations are pretty stretched right here. We hit a tight last week of 112 on the index, the OAS of the index. We sit right now just at about 119. We bounced off of 165 3 different times this year. So we think the market's priced for perfection. The big banks are benefiting from higher rates. So, if you look at net interest margins in all the earnings releases this past cycle, they all showed a pretty significant uptick. If you can put money on deposit with the Fed at 5.25%, that's really good. I met with one of the largest banks in Spain recently, and they're paying 0 interest rate on 40% of their deposits. So despite what we heard through some of the regional banks and the Silicon Valley situation, banks are still paying significantly lower than they can earn with the Fed. So you're seeing that flow through to net interest margins.
And you're seeing that flow through into money market mutual funds, which are at another all-time high in terms of assets. But Amanda, you had mentioned that you see this as a tailwind for private credit. Can you quantify that? How big could that market get?
So the global private debt market is $1.5 trillion in AUM. And so for context, that's slightly larger than the U.S. high yield bond index and the U.S. leveraged loan index. So there's pretty significant scope for growth in that market, we think, one, because of this opportunity to expand the addressable market that we outlined. But two, when you think about, and just using data from Preqin, for example, investor allocations to private debt relative to more mature asset classes like private equity, there's probably a lot of scope for private debt allocations to grow there, specifically when you think about investors that do asset liability matching and are looking for kind of long-term investments. So think insurance companies, pensions, endowments. And so we do expect a pretty significant growth backdrop there. I think in the near term, what's probably most interesting for corporate credit investors, however, is that in this backdrop of elevated inflation and Blake and Earl mentioned in the previous segment, kind of the Fed perhaps not being in a rush to cut rates, we would agree with that. So in this environment where you have a higher cost of capital, perhaps below trend growth, a challenging growth inflation policy mix, you really want to protect yourself with structural protections and credit selection in an environment like that where defaults are picking up broadly, we think. Not to extreme levels, but a moderate uptick. And I think private debt probably lends itself well for investors to introduce that granularity into their portfolios and those, in some instances, those structural protections, which we do like in the current environment.
So potentially the stars aligning for the private debt market. But John, I want to go back to the corporate credit markets, especially when you look at just overall investment grade and high yield spreads. There's really been not a lot of action. The volatility is very, very low, which is striking on its own. But then you consider what's going on in the Treasury market, which has been a little bit of a basket case. When does volatility return to credit markets?
Yeah, the credit markets are very dependent upon liquidity. So, if you look at the growth of the investment grade market, it's grown fivefold since 2006. If you look at the balance sheets provided by market makers, they've actually shrunk in that time period. So when you do hit periods of illiquidity, that's when you see spikes in credit spreads. You can see it on the graph right there in 2020, in March of 20. More liquid products like treasuries and mortgages tend not to see that heightened volatility because it's a higher quality asset and you have more balance sheet from the market makers committed to providing liquidity in those arenas. So that's part of the reason why we feel like, at 120 on the index right now, you're really not getting paid for the risk of that type of liquidity event that you could see in the marketplace.
Well, Amanda, we only have about a minute left, but come in on that point because you have seen the dynamics flip a little bit, whereas the Treasury asset class is more volatile than corporate credit. Does that potentially make high quality company debt a better hedge than Treasuries, for example?
I think probably for the corporate sector, the most important thing is this upcoming wall of maturities and the refinancing risk that needs to get flowed through. And to your point, Katie, high yield spreads in particular have been really snug relative to some of the volatility that we've seen in other asset classes. And we think the very low supply figures have been a big part of that. You noted that we're starting to see an uptick in supply, but from a historical context, supply is really light, and 2022 was a record low level. So there's been kind of this drought in supply. The one thing that I think is really important for corporate credit investors is that in the leveraged loan market, those higher financing costs are being realized immediately because the borrowing costs are moving higher in tandem with the policy rate. In high yield bond land, that hasn't happened yet, but we do expect that to flow through. And as those borrowing costs flow through, as the maturity walls move closer, then you will start to see some more volatility in high yield spreads and some widening.
All right, Amanda Lynam and John Sheehan, thank you both so much. Really appreciate it. Still ahead, the final spread. The week ahead, another key inflation print on deck. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the final spread. The week ahead, coming up, earnings on Tuesday, UPS, Rivian, and more. Thursday, US CPI, another round of jobless claims, and then Friday, PPI. But let's talk about that CPI print. Going to be the one to watch year over year. Expected to see a slight reacceleration, 3 to 3.3%. We'll keep an eye on that. But from New York, that does it for us. This was Bloomberg Real Yield, and this is Bloomberg.